So in today's video, we're going to talk about someone who we recently helped prepare a plan to guarantee that he'll have enough income during retirement. Now, right now, he is in his mid-60s. He does very well. His income is right around $200,000 per year, but he's planning on retiring in about 4 years, right around the age of 70, and he wants this. He wants to guarantee that he'll have about $200,000 per year in income starting at age 70. And here's the big thing. When I use that word guarantee, he does not want any stress. He does not want to have to worry about money. He just wants to know that that income is coming in, and he doesn't want to have to see fluctuation in the market. He doesn't want to have to manage real estate. He wants peace of mind. Okay, so we're going to go through how we did this for him. So right now, he is in his mid-60s. He has been a real estate guy his whole life. He's got about 20 rental properties, and his income, depending on the year, falls between $180,000 and $250,000 annually. So right here, it fluctuates, and we talked about this a little bit because he doesn't like the fact that 1 month it's $15,000, then another month it's $25,000, and managing the rentals can be draining. And when I say draining, I'm not talking about draining on his finances. I'm talking about draining on him emotionally. It can be taxing at times. So what he wants to do is take those properties that are draining to him. Other people could handle them perfectly fine. He doesn't want to deal with them anymore. He wants to sell these properties. We'll call them stress properties. And he wants them off of his balance sheet by the time he's 70. By the time he wants to say, hey, I'm ready to really enjoy retirement with my kids. Like 70 is my target, because I do enjoy what I do, but I just want to do it right as far as getting rid of some of these stress properties by age 70, but my income is going to go down. So how do I make sure I'll have enough income? So what he's going to do is keep the properties that he likes, that have consistently paid him, and that gives him about $100,000 per year. It's very low maintenance. He doesn't have to worry about it. Like, he knows what he's doing. He's been in the real estate game for a long time, and he knows if he keeps just the good ones, he'll keep about $100K per year. However, he wants $200,000 per year. So we'll get into the plan that we put together. However, the first thing I want to mention, because this leads into the plan, is that he is very liquid right now. One, he's got 2 whole life insurance policies. This is actually how we met initially. So this is someone who has worked with us for a while now. He's got 2 policies. They're on 2 of his daughters, but he got them primarily for the cash value to use for his real estate business. Let's look at an example of this, because this is something a lot of people are interested in, and this is something he can continue to do throughout retirement. So he's got 2 whole life insurance policies. The main reason why he got these was for cash value to use for real estate. So we can buy and sell real estate by using the cash value of his policies instead of using cash or going to an actual bank. What he wants to do, or what he's doing, is using his policies like a bank. And what that means is he doesn't have to work with an actual bank anymore. So how this works for him is as follows. We're going to use a simple example. These are not his actual numbers, but it is how it works. So if he's got $100,000 in cash value, and that is earning a net growth rate of 4%, what does that come out to? If you have $100,000 and you earn 4%, that comes out to $4,000. That means you get $4,000 that year from the life insurance company. Now, if he decides that he wants to use this for real estate, if he says, I want $50,000 because I see an opportunity, I know I've got $100,000 in my policy, let me access half of it. So in order to do this, we would take a policy loan of $50,000. Let's assume the interest rate is 5%, which is very common. Sometimes you can even see it lower than that right now with some companies. What's 5% of $50,000? $2,500. So when you take a loan against your life insurance policy, you do have loan interest, and if it's $2,500, that is paid to the insurance company. So we see an example of where we got money from the insurance company and where we paid them money. As a quick side note, If he's using this for business, there is a potential tax deduction on the loan interest. Full disclosure, I'm not a CPA. None of this is meant to be tax advice. This is all meant for informational purposes. With that said, we do see a lot of people who use their policies for business. They're able to deduct the loan interest if it's legitimately used for a business purpose. I just always encourage someone to work with their CPA or accountant, explain the fact that you are using a life insurance policy, because when you look at some of the language that the IRS has regarding the tax code around life insurance loan interest, there's some sections there that read as if we could not deduct the loan interest. But then there's sections that contradict it and make it sound like we can. So rather than take a chance on our own, make sure we've got a tax professional that can help us with something like this, if that's what you're using a policy for. In his case, this is exactly what he's using it for. So back to the policy loan here. He took $50,000. He used it for real estate. Let's assume the real estate that he acquires is earning him 6%. 6% of $50,000 is $3,000. Okay, here's the key right here. Even though he took that $50,000 loan, he keeps earning 4% on the full $100,000. With a life insurance policy, when you take a loan against it, you continue to earn compound interest on your entire cash value. Any money that you've borrowed and any money that has not been borrowed yet. So he keeps getting 4% on the full $100,000, even though he took that $50,000 loan. So here's how it works. He's got $100,000 earning 4%. That's $4,000. That is money he receives from the insurance company. Next, he borrows $50,000. The cost to borrow is 5%, which is $2,500. That's money he pays to the insurance company. Then he takes that $50,000 and puts it into real estate. In this example, we're using a 6% return, which is $3,000. That's money he receives, not from the insurance company. He's getting this from who? His real estate investment in this case. So who? It could be the tenants, but you know what I'm saying here. So when we look at this, what happened? Well, he made $7,000, what the policy is growing by, and also what the real estate investment produced, but he paid $2,500. So what's the net there? About $4,500 when we look at it. So the question here that a lot of people will ask is, does it always work like this? Will I always have a positive spread? And the answer is no. So when we look at a life insurance policy, here are the most important items to be aware of in order to set ourselves up for success. And this really mimics the model that you'll see corporations and wealthy individuals that have third-party advisors that are helping them select the right policy do. Number one, company selection. That means not the agency, so not if you're working with my company or another independent agent or anything like that. This means the actual insurance company. What I want with a whole life insurance policy is to see that the company that I have that policy with has actually delivered, meaning not just shown good-looking numbers on paper or say, we have this great dividend history. It's like, no. I want to see a real policy that was started 10, 20, or 30 years ago, and I want to see the actual returns, the internal rate of return that the cash value produced. And where we've seen attractive internal rates of return of 4% or more are really with 4 companies consistently, which are Mass Mutual, Guardian, New York Life, and Northwestern Mutual. My advice is always, even if you don't even talk to us, regardless of the agent you speak with, make sure that you're at least considering one of those companies and looking at numbers with them too. So important to do, and it's overlooked so many times. Next, the product design. We just want to make sure that it's set up for maximum cash value. Make sure in the first year, your cash value is somewhere between 80 and 90% of what you pay into the product. Meaning if you pay in $1,000, I want to see $800 to $900 show up in cash value in the first year alone and have a break-even point somewhere between 3 and 5 years on average. And then the last point here, which is always important to be aware of, it's always going to be negative in the first few years. And I just kind of hit on that when I talked about look for 80 to 90% of whatever you pay into the policy in the first year. If you pay in $1,000 and you have $900 in cash value, what'd you earn? Nothing. You actually lost 10%. The same is true for the individual that puts in $100,000 and they have $90,000 in the first year. That's a $10,000 loss. That is the drawback when it comes to whole life insurance that's set up for high cash value. So where this typically goes wrong is if I don't understand the drawbacks, particularly the early years where it's negative, or the fact that the net interest rate can be higher than the net growth rate on the policy. I want to look at the numbers, but where it goes wrong is when that wasn't explained, or I didn't understand it correctly, or it wasn't disclosed to me very, very thoroughly. It was just skimmed over. It's like, nope, pause, make sure we go to the drawbacks, make sure we show everyone the important items that we would want to see if we're sitting on the other side of that table, and then make sure they still want to move forward. In this case, you still want to move forward after you understand those drawbacks and why some people don't do this. So important, it prevents all of the headaches that typically come with whole life insurance, which no one wants. Which if you do that right, it leads into this. Most love this after understanding the drawbacks. So that's why he has money in whole life insurance, and he's been using that for real estate. On to his plan. I hope that section was beneficial there. So we mentioned he's liquid. He's got about $850,000 in a money market right now, and it's usually not this high. He doesn't keep that much cash on him. Why it's that high right now is because he recently sold a property. Remember where we mentioned he's got about 20 rental properties and he's trying to sell off the stress properties by age 70? He just sold one. So he's got some cash there, $850,000, which is way more than what he needs. So here's the plan in order to guarantee $200,000 per year of annual income. Today, he's 66 years old. What we're going to look at specifically is moving $500,000 from the money market into an annuity. And the annuity is going to pay him income. In this example, we'll start the income at 70 years old. Sound good? Let's stop. I'm not just going to dive into the annuity. Question that I asked him, and I can ask you the same thing. Are you familiar with annuities? Have you heard good things or have you heard bad things? And asking him this question, are you familiar with annuities? He said yes, but then he said, I looked at one in the past and I did not like it. And the reason why, Steve, was because when I saw the illustration, if I died before I got my money back, the insurance company would keep it. I had zero interest in it and I dismissed it at the time. This was several years ago. So in hearing that, that is extremely valuable information to hear because firstly, it makes sense. I would not do that either. There's no way I would put my money in that type of product if they're going to keep my money if I die. I'd want my wife to get it. But it's also very, very easy to avoid. No worries, no need to be concerned at all. If we set the annuity up right and you die before you use all of your money, or let's say before you use any of it, your family will get the balance. And we can look at exactly how that will work. Let's take a look right now, shall we? So here we've got an example, and take note of what you see up top. What do you notice here? Guaranteed rates. So this is displaying an absolute worst case scenario. 66 years old, he's moving $500,000 into this product. Now this column, annual withdrawals, displays what he is getting in income every year. So here we see it's 71. There's $56,000 per year that's generated. It starts at age 70. It's at the end of year 5, he turns 71. That's why we see 71 there. I don't like the way that it's displayed, but we're starting it at age 70 or right around the time that he wants. But this is showing how much income he is guaranteed to receive forever. 56 grand per year. We'll come back to this. Then we've got all these other columns. Here's the main thing I want to highlight here. death benefit. What is this? This is showing if he dies, the balance that is paid to his beneficiaries. Now we are looking at the guarantees here, which illustrates an absolute worst case scenario. The income is guaranteed at that number, even if that balance goes to zero. Doesn't matter. If he drains the account, he still gets the income forever. That's why people like annuities. But if he dies before he receives all of it, let's say something happens to him at 75 years old, there's a balance of $225,000 that would be paid to his beneficiaries. Make sense? Cool. Now that's worst case. Let's look at the next page. Based on the current rates, the income will be exactly the same here. What is different is we'll actually see some earnings here. So before he takes money, the balance is actually going up. The income's not affected. He's guaranteed to receive that forever no matter what. This will last longer. So if the account performs, it's an indexed annuity, but we're getting it for the income, so I'm not too concerned about the growth. But if it does perform at a high rate or high level, and he dies before he drains the account value, whatever's left over, we see is paid to his beneficiaries. That was the big objection on his end. That's what he was concerned about. So we spent a decent amount of time on that, just explaining it and then highlighting it in the illustrations so we could see exactly what that looks like. Make sense? Cool. All right, let's get back to the plan, which is guaranteeing income of $200,000 per year. How are we going to do that? So at 70 years old, he's going to get Social Security of $55,000 per year. He knows that that's guaranteed, hopefully. So he's got the $55K per year. He's got the real estate that he's keeping, the stress-free real estate that he wants to keep. That'll give him another $100,000 per year at 70 years old. And then we're going to take $500,000 from the money market, move it into an annuity today when he's 66, and this guarantees him an income of $56,000 per year starting at 70 years old. See where we're going here? Add the two up. What do you get? $211,000. Pretty cool, isn't it? Let's wrap up by looking at the actual numbers. First, we'll go through the annuity, and then we'll look at everything together. So the annuity, we looked at the illustration already. The last thing I'll mention here, he did ask if there's a way we can start with a lower income and then have it increase. So here we've got guaranteed withdrawal options, meaning what you see is what you get. But when we look at this, here's the level income. So if he starts at 70, he gets $56K per year forever until he dies. If he says, hey, I'm kind of concerned because we've got this thing called inflation that's been a real thing lately, everyone's feeling it. Can I set the product up so my income increases once I begin? The answer is yes. You will see a lot of companies offer this. So with these options, typically we start lower. Instead of 56K, starts at 48K. But what happens over time? It increases every year to adjust with the cost of living, which is really nice. So that's a nice option just to be aware of. We do typically need to select this up front, but again, it's a nice option. All right, so what we've got here is firstly an income sheet. What this is showing is when he starts taking income, here we had age 70, he gets $56,000 in change per year. If he said, I want to start at 67, he can. He does not need to decide this up front. He would get $44,000 in change per year, and that's the amount he would get every year forever. So whenever you start, that's the income that you're locked into. All right, let's continue on. When we look at the annuity itself, here we go. We've got the deposit of $500,000. There's our annual income, starting at 70 in this example. Then we've got the total income. This way we can tally up what we received here. And what I've got here with these numbers, 9, meaning 9 years it takes until we got our $500,000 back. At that point in time, he's 78, and he keeps on getting that $56,000 in change indefinitely. So it keeps on keeping on, which is fantastic. And then lastly, let's look at the full retirement picture, before and after. So right now, he's working. What's happening to his income though? Remember where we mentioned it fluctuates between $180,000 and $250,000 per year? Well, what's going to happen as he sells off that real estate, it's going to decrease. Also, what'll happen is he'll keep on piling up more cash, which he can use for other things, including living on if he wants to, because when he sells those properties, a lot more cash is going to come in. He doesn't have much debt, so he's done a really good job over time. But focusing on the income, here's what we've got up until 70. It might be a little bit lower than that. So now, let's take a look. We've got the rental income from the properties that he likes, 100K per year. Then we've got Social Security, also starting at 70 years old. Then we've got the annuity income, $56,000 per year, guaranteed. When you tally it up, what do you see? His target was 200K per year at 70. What he'll be at is more than that, which is really what we want, because if I told you 4 to 5 years from now, I want 200K per year in income, is that 200K going to be the same 4 to 5 years from now? No. What about 20 years from now? No. So let's overshoot it. This way, in the event that life happens, or I just want to be generous and give some money away, I can do that now. And again, when we put these plans together, he's got additional assets. He's got a lot of liquid cash. He's got the life insurance policies. There's more going on than this. But what we're really focusing on here is the income side of things. That was his primary point of interest. So I hope that you enjoyed this video. I had a ton of fun working with this individual. His name's Jeff. I had a ton of fun working with him and putting this together. Let us know your thoughts and if you have any questions at all. And as always, I hope this helps. Thanks so much for watching.
Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.